Welcome back to lesson 2 of Company Valuation 101, and in this lesson we are going to be diving into the spreadsheet and looking at how we would value a company and calculate its intrinsic value. This spreadsheet is loosely based on Phil Town's Rule 1 investing valuation model, and we've adapted a couple of things just because I felt his model was a good base, but it was a little bit overly simplistic, and I thought I would tweak it a little bit, and we have made it so it's a bit more robust and it works for high growth companies and also companies that don't yet make any money. So in the next lesson, I'll be discussing how to use this sheet on companies that are currently unprofitable. But in this lesson, we'll be using it for companies that are profitable, which is the majority of companies you'll be looking at. So on the screen now, you'll see the Google Sheet I have. First thing to note, you will not be able to edit this when you open it up. When you go to freemanpublications.com/valuation sheet, you will have a view only version. What you need to do if you want to edit it is you click on File and then you click on Make a Copy, and then this will come up and it will say where do you want to put it, and you will just put it in your Google Drive and then you can edit that version. So that's just for you to know. If you accidentally mess up the formulas, or if you accidentally delete something, just go back to freemanpublications.com/valuation sheet and then make another copy of the original sheet, because this one you're seeing on screen right now will not change. I won't edit this and no one else will edit it either. So that's what you should do if you accidentally delete some fields. So let me just explain what all of this is, because it looks a little bit complicated now, but it's actually quite simple. And you can do all of this using just this spreadsheet and free information you can find on the internet. Unfortunately, now that Yahoo Finance is so detailed, you only need to use information on Yahoo Finance to actually fill in these fields, because Yahoo Finance is such a comprehensive resource now, and that's 100% free, so you don't need to pay a penny to use any of this, which is good for you as an investor, because that means you have more money to use on actually buying stock. So this sheet has a few parts, and as you can see here, I'm on a sheet called Default Do Not Delete. As it says in the name, do not delete the spreadsheet. Once again, if you do accidentally delete this one, then just go back to freemanpublications.com/valuation sheet and make another copy. So you're on the default sheet. When you want to do a new valuation for a new company, just right click and then click on duplicate, and then you'll see here copy of default do not delete, and then just rename it to the company you want to look at. So I'll just quickly delete this one and go over to this one, because we want to look at Coca-Cola. And this is one I haven't filled in yet. So let's fill it in together. So there are 5 fields here that we want to fill in. We have earnings per share, which is the amount of money the company makes per share that is issued, and that is earnings. So it's not revenue, that is actual profit. So it's earnings per share. We have the growth rate, which is the rate the company is expected to grow over the next 12 months. We have a minimum rate of return, and what that is a rate of return we as an investor would be happy with. So we want to beat the market. And so, as I discussed in the 8-Step Beginner's Guide to Value Investing, the market average for the past 50 years is 9.69%. Now, we want to achieve a rate of return higher than that, because if we were just content to receive an average rate of return, we wouldn't even bother buying individual stocks. We would just buy the S&P 500 every year. So obviously we want a greater return than the average. So this is why I use 12%. I've seen other people use higher. But personally, I would only recommend you use 12% because that is an achievable target without being way over the top. Because the higher you have this number, the higher the price that you will need the company to go to, and the lower price you'll need to pay today, because $1 in 10 years' time is not the same as $1 today. So if you're expecting 25% rate of return, you're looking at for the share price to be much higher in 10 years' time than it potentially will be. And therefore, I recommend keeping this at 12. Margin of safety. Oh, I discussed this in the previous lesson. This is just the appropriate discount based on your experience and based on your knowledge of the company. Because as investors, you are going to be wrong sometimes. There is not a single investor alive who gets 100% of their picks correct. Warren Buffett doesn't. Peter Lynch doesn't. I certainly don't. So this is why we have margin of safety, because we want a built-in price where we can still profit even if our picks are incorrect. So the example I like to use is if you are a CEO of a public company, your margin of safety for that particular company should be 0, because as the CEO, you should know every single thing about that company and the direction of it, its potential competitors, the potential hurdles, the potential risks going forward. So your margin of safety should be 0. If you know a company very well, say Coca-Cola, for example, because that's what we're going to use. It's a well-established company. You know the business model very well. A reasonable margin of safety is 20%, because not too much could go wrong, really, with Coca-Cola's business. If it's a younger company, if it's a company in a sector you have less experience in, then just increase the margin of safety. Say go from 20 to 35%. Now there are no hard and fast numbers for this, but I would recommend playing around with the margin of safety just to see what kind of numbers that it comes out with in terms of fair value for you to pay today. And, you know, I've seen people go up to 50%, and that's fine, but trying to buy companies at a 50% discount, which is what this number is a proxy for, is quite difficult. So just bear that in mind. But for Coca-Cola in this example, I'm going to use 20% as our margin of safety. And then we also have price to earnings ratio, which is simply the price of the stock divided by the earnings of that stock. And for the S&P 500, right now, it's about 26.5, I believe, is the average. For these higher growth companies, you will see PE ratios of upwards of 60, 70, 80. I think Zoom's PE right now is about 400 as I'm recording this video. So that just gives you an impression of how skewed PE ratios can be, especially for these high growth companies. So just bear that in mind. And I will elaborate a little bit on that later when we talk about valuing high growth companies, because the model is slightly different for those. But for now, let's just do Coca-Cola and let us see how this Google Sheet works. So the first thing we need to do is we need to find out the share price, and just click on this summary tab on Yahoo Finance. Once again, this is all completely free. So we'll say 48.81 because the market's actually open right now, so this might fluctuate a little bit, but for this example, we'll do 48.81. So I'll put this up here. And now we need to find earnings per share for the trailing 12 months. And you'll find that on the summary tab of this page. So earnings per share trailing 12 months were $2.12 per share. So just put that in there. Growth rate. For this one, we need to go on the analysis tab on Yahoo Finance. And what this is, it's a collection of earnings estimates from different analysts. As you can see here, for the current quarter, there are 16 analysts, and it's an aggregate of those. For next year, there's 22 analysts. So the more analysts, the better, just because law of large numbers. We're more likely to get a true estimate with 22 analysts than one, for example. So now we scroll down and we go to this tab, which is growth estimates. And the one we are concerned with is next year's growth estimate. Because initially when we recorded this video, we were using this number. And I was getting a lot of feedback from people saying they just couldn't find any profitable companies using that number. And in hindsight, I agree with them, because this is heavily depressed because of everything that happened in the past 6 months. And lots of companies that were previously growing at 20% per year, you know, the analyst estimates for the next 5 years were down at 1 or 2%, which is very depressed. And so this is why we've switched to this number now, which is next year's number. So if you first watched this video a few months ago, you will see in the video title that this is update September 2020. You've probably been using a different number. So use this number next year going forward. So next year, 14.4%. And as you can see now, when I've put that in, some numbers are populating into the spreadsheet. The final number we need is the PE ratio. So for that, we go back to the summary tab. And we have here PE ratio trailing 12 months is 23 exactly. So just put that in here. And now the spreadsheet fills in. So I will show you what all of these numbers mean now. So in year one, which is this year, this is our earnings per share, 2.12. And to get our forward projection, what we do is we multiply the current earnings per share by the projected growth rate. So this number in year two is simply year one's number multiplied by 14.4% to get to this number. And then we keep doing that until we get 10 years out. So if Coca-Cola continues to grow at 14% a year, then the earnings per share in year 10 will be $5.14 a share, which at this PE ratio will give us a share price in 10 years of $118.23. Now, before you go and jump and say, okay, it's less than $118, I'll buy it now. Once again, the value of $1 in 10 years is not the value of $1 today because of inflation and because of other factors. So if Coca-Cola is worth $118 in 10 years' time, what is it worth today? And to get that number, what we do is we divide year 10's number by our minimum rate of return, because we want to make 12% per year. So therefore, we're going to discount it 12% per year going back to year one. And so what that does is it gives us this number here, because it says, okay, Coca-Cola is projected to grow at this percentage. In year 10, it will be worth this much. Therefore, at our minimum rate of return, this is how much we can pay for it today to get to that number. And this number is $42.64 per share. So that number's here in fair value today. And then we have this number, fair value with MOS. So that is just margin of safety. Remember, I was talking about margin of safety is the proxy for a discount. And that is the discount here. Because our margin of safety is 20%, this is the discount that we're willing to pay based on our margin of safety. Let me just change this and show you what I mean. So if I change this to 50%, as you can see now, this is 50% of the fair value. As I mentioned at the beginning of the lesson, at a 50% margin of safety, you're going to struggle to find companies to buy, just because that discount rate will be so high that everything will appear as overvalued. So let me just change this back to 20%. So we've got 42.64 as the fair value today. Coca-Cola is currently selling for 48.81, which this is dynamic, by the way, so this will change based on the price. So we would consider that overvalued. Let's say it was selling for exactly $40 a share. You can see this now changes, and that's a fair price. If it was selling for $35 a share, we would consider it undervalued. If it's selling for $30 a share, that would be considered a bargain. Now, what I would encourage you to do is do this for a bunch of companies you're either currently invested in or are thinking of buying. And just see what the prices are like. You may get some that are undervalued, you may get some that are overvalued. But ultimately, this is just a good way to gauge the share price in relation to the current performance and projected future performance of the company. Because, like we said in the book, the share price at any given time is just a combination of millions of people's future expectations of a company. So, are those future expectations in line with the actual numbers? So, the earnings per share, the growth rate, the PE ratio. And this is all this is. Because there are no perfect models for valuation. If there were, everyone would just use the same one, which is why you'll see a lot of different valuation models out there. And there's a great quote, and I believe it is, all models are wrong, but some models are useful. And this is how I view this model, in that it's just a useful tool for you to analyze different companies and their valuations and if they are worth it. So 48.8, overvalued according to this model, and that is the basics of using the valuation sheet. Now let's go on to the high growth sheet. Now, the only difference is, and I've got this here highlighted in yellow, the difference between this and the normal default sheet is that this one is used for companies with a growth rate of greater than 25%. So if a company has a growth rate of more than 25%, we would consider it a high growth company. Because a growth rate of more than 25%, that indicates that this company is growing very fast. But what that also indicates is that is probably not sustainable over a 10-year period. So what we actually do is, after 5 years, we cut the growth rate in half. And we just use that as a proxy for growth is probably going to slow down going forward. And so, same principle here. So if you see a company with a growth rate of 34%, like Amazon, for example, just copy the sheet. Just duplicate it. And then you'll have the duplicate copy, and then you can fill it in with whatever company you want to use. So let's just use Amazon for this example. It already exists. So let's call this Amazon 2. And you put in the numbers the exact same way as you would on the default sheet, and you don't have to change anything because this formula is already built into the sheet. So just put everything in as you would. So for here on Amazon, earnings per share, $20 per share. Growth rate, 34%. The PE, like I said earlier, these high growth companies have very high PEs. The PE for the trailing 12 months was 71.45. And so with those numbers, we would expect Amazon's share price in year 10 to be $10,576. which, might seem a lot now, but at the growth rate it's going, that's not an unreasonable target for 10 years' time. That's only a 300% growth from where we are now. And many of these companies have displayed that they can grow 300% in a decade. So don't be alarmed when you get numbers like this, because we'll still discount it at 12% a year. So at that number, this is what we are happy to pay in year one. So that's $3,800 per share. Now, with a 20% margin of safety, we've still got $3,000 a share. And let me just check today's price on Amazon. So it's $2,906 a share. $2,906. And so even with that discount and even with that margin of safety, still a bargain according to this model. So even though on the surface you look at Amazon and you think, God, $3,000 a share, that is really high. It's not about the price of the shares. It's about the price of the shares in relation to the company's growth and relation to the PE ratio. So a lot of the times new investors, they get caught up in share price and they think, okay, 3,000 too much. Let's look at companies with share prices of $10, $15, $20, $30. It doesn't work like that. Share price has zero indication, and this is share price in a vacuum, has zero indication of whether a company is good valued. There are a lot of terrible companies trading for less than $20, and there are a lot of great companies trading for more than $500. It's not the share price that matters, it's the company associated with it. So I hope this has been useful to you. If you've got any questions or if you have any trouble with the actual sheet itself or any technical questions, please just email me at admin@freemanpublications.com. I'll be happy to help. Thank you for everyone for their feedback on this video course thus far. It's been very helpful, and it's helped us iterate the lessons and make some updates to them. So in the next lesson, I'll be continuing within the spreadsheet, and I'll be talking about how to use it for an unprofitable company, because the way we would calculate that is slightly different. But don't worry, same as this lesson, I will guide you through it step by step. So I hope you enjoyed this lesson. Thank you for watching, and I will see you in the next one.